Yesterday, investors dumped a staggering $100 billion in U.S. bank stocks in a single day. What spooked them? It wasn't a massive scandal. It was two smaller lenders disclosing losses tied to alleged property loan fraud. The losses themselves were just tens of millions, a drop in the ocean for the banking world. But the market's reaction tells a bigger story. Why did this small tremor cause such a massive earthquake? It's because these losses didn't happen in a vacuum. They came right after a pair of recent bankruptcies linked to loose lending. And as one top bank CEO likes to say, when you spot one cockroach, you worry there are more. Today, we're not predicting doom. We're simply connecting the dots so you can understand what's really going on. Let's rewind. The two banks, Zions and Western Alliance, revealed these losses. Again, financially, it's not a disaster for them. But context is everything. Just before this news broke, two companies, Tricolor Holdings and First Brands, went bankrupt. Both had ties to questionable lending practices. So, when the banks announced their fraud-related losses, investors started to see a pattern. They began asking a critical question. Who else was lending fast and loose when money was cheap? Who else might be sitting on a pile of bad loans? That's when the selling frenzy began. Roughly $100 billion in U.S. bank shares were sold off as investors rushed for the exits. That cockroach quote I mentioned? It came from J.P. Morgan's CEO. He wasn't trying to spread fear. He was urging caution. But the market heard an alarm bell. So, why does this matter beyond those two specific banks? It's all about the financial plumbing. You have two main types of lenders in the system. First, you have the traditional, regulated banks. Then you have private credit funds, which operate with less oversight and are generally seen as riskier. Here's the crucial part. These two worlds are not separate. They overlap. Banks often lend money to private credit funds or partner with them on deals. They are financially intertwined. So, if a private credit fund makes a bad bet and can't pay its bills, the banks that lent to it feel the pain too. It's a two-way street of risk. Now, here's the uncomfortable parallel that has everyone on edge. The 2008 financial crisis didn't start with a system-wide collapse. It started with a few subprime mortgage defaults. Just a few. And then, the dominoes began to fall. Now, I'm not saying we are on the brink of another 2008, but the market has a long memory. When even small cracks appear in the lending system, people sit up and pay very close attention. This is why a small event can trigger such a massive reaction. Let's zoom out. Why has private credit become so popular recently? It's simple. Investors were chasing better returns and diversification. It seemed like a smart move. But a recent study found something interesting. Many of these private credit funds deliver the same returns as regular corporate loans. Not better, just the same. That's a problem if you thought you were being paid extra for taking on more risk. And here's another issue. Many older private credit funds are still waiting for their loans to be paid back. This raises the question, will the profits they promised ever actually show up, or were they just wishful thinking? This matters because it's not just Wall Street pros playing in this space. Pension funds and insurance companies, which manage the retirement and savings of everyday people, have money in private credit. If more borrowers default, the fallout could ripple through the whole economy, affecting everything from business loans to your retirement account. So, what's the takeaway here? Two things can be true at once. The losses we've seen so far are small, but the system is more fragile and interconnected than it appears on the surface. So, what should you watch for next? First, keep an eye out for more fraud disclosures from other banks. Second, pay attention to how much exposure big banks have to the private credit world. And third, watch funding costs. If it gets more expensive for banks to borrow money, that's often an early warning sign of trouble ahead. The bottom line is this: this is not a moment for panic. It is a moment for paying attention. In a system this connected, small sparks can cause big fires. Stay calm, stay informed, and don't get swept away by the headlines. If you found this breakdown helpful, please hit that like button. And for more analysis that cuts through the hype, make sure to subscribe. Thanks for watching, and I'll see you next time.